In this video, renowned trading coach and author Dr. Brett Steinberger and I present live to a proprietary trading firm in the Philippines how the best active proprietary traders are reaching new levels surprisingly.
Hi, I'm Mike Bellafiore, co-founder of SMB Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the Playbook. Click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community.
Learn how top proprietary traders are getting even better so you can grow your trading account.
So, Dr. Steinberger, I think we had discussed giving some of the students a preview of how we do things at SMB Capital. So,
Great.
One of the things that we do on a day when Dr. Steinberger visits and coaches and mentors our traders is we ask him to give an overview of what he's seeing in the markets. And so he has the pulse of what big money traders are doing, hedge funds, sophisticated traders, some of the biggest traders in the world, both as discretionary and quantitative traders. We are price action, active, proprietary traders and have a different perspective. And so it's very helpful for our traders. It's very interesting to me, and it'll be very interesting for you guys to hear, hey, what are some of the more sophisticated people in the world thinking? And what is Dr. Steinberger seeing in his own work with his own trading and the people that he's talking to? So Dr. Steinberger, what are some of the main themes that you're looking at in the market today?
Well, thanks, Mike. In the U.S. Stock market, we're seeing something very, very interesting. We saw a situation where obviously we had a big decline from mid-February to mid-March. And then we had quite a rally off that March bottom, particularly in certain sectors of the market. What the equity long-short investors that I work with were doing was picking the companies that they felt would benefit in a COVID environment and pick the companies that were vulnerable. So they were long the companies that would be secure, like some of the technology shares, and they're short some of the companies that they felt would be vulnerable. Banks would be an example because of the number of bankruptcies and economic decline. Then we saw recently a change in the character of the market. Small cap shares, which had been lagging, suddenly started to outperform some of the sectors that were beaten down, including things like airlines and cruise lines and things like that. Suddenly we got a lot of value-oriented buying in those shares on top of the buying in the strong companies. So we had a big increase of breadth. And normally that leads to momentum, upside momentum going further. What happened late last week is a big reversal of that. The decline that we saw recently is not a normal decline. The decline we've seen in the overnight action in the S&P futures, the ES contract, this is not normal. Why do I say that? Because if we look at the percentage of stocks trading above their short-term moving average, so the percentage of S&P 500 stocks trading above their 3-day moving average, above their 5-day moving average, it's well under 10%. In other words, in the last few days, it's not just that the market has gone down, it's that everything has gone down. That is unusual following a period of strong breadth, following a momentum move higher. Now, why would that be? Why would the market suddenly reverse so violently across all of the sectors? There are two things that the money managers I speak with are talking about. One is the decision of the U.S. administration to entertain the idea of a punishment for China for their handling of the coronavirus situation, including possible tariffs. So if you add a trade war to an already very vulnerable and weak economy, well, that starts to sound a little bit like a replay of the 1930s and the tremendous depression that we experienced. So that's a concern. The investors are looking for signs of a growing economy or a possibility of growth, and anything that would threaten that is really a problem. The other issue that they're pointing to is that if you look at the mobility data coming from smartphones, so we can track smartphones and we can figure out if people are moving around and where they're moving around to. Apple has made these data available. Basically, in the US, the lockdown, the sheltering in place, the social distancing, whatever you want to call it, it's ended. It's over. It doesn't matter what the governors say. It's over. People are congregating, people are traveling, people are shopping. My wife and I drove around in our car, and we observed this just in our local area. And so people are tired of being indoors, and I certainly understand that. And that, in the eyes of the money managers I speak with, that is likely to lead to a second wave of the virus and further problems, and markets take that very seriously. So we have two things that have come up that are potentially big issues that I will be tracking going forward.
If you want to learn 3 real-world setups that our traders use, including the simple setup that we teach all of our new traders and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing right now at the top right-hand corner of your screen. That's going to open up this free registration page in the new window, so don't worry, you're not going to lose this video. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
After Dr. Steinberg's remarks, what we'll do is we will start to drill down into specific names. We will start to talk about the stocks that are going to be most in play. That is what we're going to be thinking about. So for a day like today, it's a little bit early, or late in the sense of
It's very late,
guys.
Mike.
No, don't worry. Everyone here is trading the U.S. market, so we're good.
So
we'll be awake at the same time as you guys.
So for us, it's a little bit early, but we're going to look at a company like Gilead. Gilead is gapping up a little bit. It's in play. It seems like their drug will be used by more people, and the information coming out from them is getting a little bit more promising based on what people's perceptions are. We're going to be looking at the airlines. Warren Buffett headline across any of the major news outlets is that he's turned on his opinion of the airlines and thinks that those businesses are materially different going forward. We're going to look at a company like CGC that just put out news on how their company is doing overall. We're going to be trading the overall markets because they perform poorly overnight. They certainly are in play. We'll look at volatility to determine whether or not we're going to trade the overall markets. When volatility is elevated, we will trade SPY and Q and IWM and VXX and UVXY. We will trade them on a momentum basis. We will scalp them. If we start to see direction, we will swing them. We'll go around the room, and our junior traders will share their best ideas. Those are going to be the first ones that go on a day like today, but we'll also look at second day plays. What was really working on Friday? So a company like INO is something we've been watching. Maybe something like mRNA has been a high flyer that we've really been watching. And we'll take a look at the really significant levels that we saw from Friday and some of those names. Tesla is a company that was in the news on Friday after Elon Musk put out some of those funny tweets, which nobody can really understand, in the middle of the day and caused Tesla to drop quite a bit. So that will be something we're looking for. Is what we call a second day play, something that may follow through. But you had asked previously, hey, what are some of the things that we're doing, before the open? And the way that we start is my partner, Steve Spencer, will hold his AM meeting. So he is the experienced 20+ year trader, and he will share technical levels of importance in the stocks that are in play, where you might find buying and selling. That is a 15-minute meeting that he broadcasts to all of the new traders and actually even people in our education community at SMB Training. Then our floor manager has an AM meeting as well. This is for the newer traders. This is where we go around the room and each of the junior traders gives their best idea, and we'll comment, hey, that's a good idea. Hey, that isn't a good idea. Why don't you take a look at this? You didn't think about this when preparing that idea. But we're looking for stocks that are in play, and I cover this in our first training program, SMB DNA. We're looking for stocks that have a catalyst, whether that's a news catalyst or a technical catalyst, a technical analysis catalyst. We want something that's going to be moving today. There's something behind it. So the airlines have a news catalyst behind it today. Warren Buffett is telling the world that he is not as confident in the airline stocks as yesterday. That's new, unusual news. That is going to be in play. Gilead has a news catalyst behind it. That is going to be in play. CGC has a news catalyst behind it. That's going to be in play. Tesla will have technical catalysts behind it from day one yesterday. That will be in play. We're looking for oversold and overbought conditions to tee up technical trades that we might look for going forward. We will spend a lot of time looking to short things that have been overbought. We're looking for ways to buy things that have been oversold. We'll have an audio and a chat intraday to communicate with each other. And so you had asked, hey, what gets us interested right on the open for particular trades? Eleanor, you had sent over a question for Dr. Steinberger and myself. And Dr. Steinberger, maybe you'll talk a little bit about the volume right on the open that you teach us and our newer traders so much about, that tips the hands of big orders from the big money traders, how they're leaving footprints for the rest of us to follow.
Yeah, I would be delighted, Mike. If I could just back up here, because I think you're saying something very important. When I first started working with the SMB traders, the one lesson that I came away with that I hadn't appreciated in my prior work is what you trade is just as important as how you trade. I think what the morning meeting accomplishes is focusing traders on specific stocks, specific areas of opportunity that morning, right here, right now. And the opportunity set is so much greater in those areas than if they were just generically trading an overall index, that it accounts for a large part of their success. One great way to figure out what's in play and where the opportunity is to work as a team and share ideas. And that's what the morning meeting accomplishes. Okay, so early morning volume. Who's involved in the market during early hours? The large institutions that I work with, they have to participate when there is greatest liquidity. And in the U.S. stock market, that's early in the day and late in the day. And so early in the day, you will see the buying and selling activity of large institutional participants that move markets. These are portfolio managers trading hundreds of millions of dollars in their portfolio and sometimes north of $1 billion. And it also includes very large participants like the one I was talking with this morning, where they're really not even doing trading. They're an asset manager and they're moving very large flows from pension funds and sovereign wealth organizations, much larger than hedge funds. So they're all active in those early hours. And we can use tools to figure out, are they leaning toward the upside or downside? Do they have a directional bias for the day's trade? So when we look at Friday's trade, for instance, we could see that there was persistent hitting of bids. We saw that when orders came in, I should say transactions came in, that were occurring at the market offer price, the market was not able to go up. Instead, those orders were absorbed and we saw subsequent hitting of bids, transactions occurring at the bid price. This is called a delta indicator, which meant that sellers were more aggressive. The same information was coming across in the NYSE tick, T-I-C-K, which tells us how many stocks are trading on upticks minus the number trading on downticks. And that number started negative and stayed negative through much of the session. So we saw institutions aggressively selling. And when there was buying, when we saw positive upticks, when we saw transactions occurring at the market offer price, the market was barely able to budge higher. The buyers were trapped, and that led to subsequent selling. So by seeing what the big players are doing, we, you and me, are able to be more nimble than they are, and we can jump in front of their orders and take advantage of what they're doing.
So, Eleanor, you had asked us, Dr. Steinberg and myself, to
Yes.
answer a couple of questions. I'm going to start with one of them, if that's okay.
Yeah, please go ahead.
What are the most important processes that you go through with your traders to keep them motivated, especially in these times? Or do you expect your traders to self-regulate themselves based on your screening criteria before hiring? One of the traders on our desk that Dr. Steinberg and I are very fortunate to work with is Shark.
Mm-hmm.
So when you become a great trader on our desk, you earn a nickname. And so Kenny's nickname is Shark, and he certainly is a great trader, has become a great trader. Started out of college, didn't know very much about trading, if anything at all, and grew with our firm, grew as a trader from the beginning to now a really terrific trader. So one of the really tremendous milestones that you can hit at our firm is to be able to make $2 million net in P&L for the year. And if you earn more than $2 million net in trading profits for the year, you earn a black shirt. And this is Shark receiving his black shirt. I remember, and it's such a great question that you've posed for us, I remember the first time that Shark had one of those really, really big years. He did a yearly review and set goals for the next year. We do this with all of our traders. And in his goals for the year, he set out future goals, which when I read, just gave me pause. I was taken aback. My jaw dropped. I was stunned. And he had laid out what he wanted to accomplish going forward as a trader after just having this monster year. And, when I started a firm, I always want to think that our traders are going to grow and do really well. And the firm that I started at and learned at had great traders and tremendous success. But he wrote in his yearly reviews, his next goal was to make eight figures as a trader. And so the best traders, the elite traders, don't need to be motivated. They're self-motivated. In fact, I would look at it a little bit differently. It's our job to make sure that they are in an environment where they can keep learning. It's our job to make sure that we have the resources that they can do more, that we have the infrastructure where they can trade more products, they can trade bigger, they can trade with more sophistication, they can be around newer traders that will inspire them to keep getting better, experienced traders from whom they can learn, technology that will help them trade better and bigger. That's what we see with our guys. And I'll mention one more thing, which is, so recently I was in London, and Mr. Lee, you mentioned how this is a period of time where you have been as busy as ever. We've been busy as well. And one of the trips I took recently was to a futures firm in London, and their traders asked me a very similar question. These were guys who were making a lot of money as well, and interested in, how do they keep the momentum going? How do they keep their motivation to keep doing better after they've made so much money? And Dr. Steinberg has had one of the great talks that I've actually ever heard in our training room, which maybe he can talk a little bit about later. But what I shared with the traders at this futures firm, and what Dr. Steinberger will share with our traders, and what I'll share with you guys, is good is not good enough. And the great traders don't accept good in anything they do. They don't accept it in their daily reviews. They don't accept it with their work on technology. They don't accept it with their individual workouts, with their diet, with their sleep patterns. They don't accept it in any form of their life, and it's across the board. And so it's not about, for them, money or getting to a place in their career where they've achieved things. What they're interested in doing is continually trying to get better. Dr.
Mike, can I give an analogy?
Yes.
Yeah, if I could give it an analogy. Okay, so I'm a psychologist, right? And I've been reasonably successful from a financial vantage point as a psychologist, both working with financial firms, teaching at a medical school, etc., also through my investments. Okay, so I've made a good amount of money as a psychologist. So the question could come up, you've made so much money, how do you find the motivation to want to keep helping people? Like, you've already made your money. Why should you want to go help people? I mean, it has nothing to do with money. When you are invested in the process of what you do, when what you do is meaningful to you, then the P&L is not your primary motivator. And I think that happens with great traders. I think that happens with great folks in any profession.
Traders ask, how long do you sit patiently waiting for a trader to develop, especially after seeing their potential? Do you believe there are natural-born traders, those that only need a little guidance to become successful? One of the resources that SMB shares with the trading community is our YouTube channel. You can go to YouTube and type in SMB Capital, and we share a bunch of free videos to help traders improve on our channel. So recently we had one of our junior traders present, and the backstory to one of our junior traders presenting is, in March we had the best trading month that we've ever had. It was a historic month for our traders, and Dr. Steinberger and I were discussing how do we leverage the success of all of our traders in perpetuity so that everybody can learn from the success of our star traders, our junior traders that did really well, our middle class traders who reached new levels. And so, one of the junior traders who had done particularly well, was moving into his second year. And it wasn't really until the second year, and this was a trader who was a very top recruit by our firm, showed experience that was promising, showed bandwidth that was promising, really a strong passion for trading, which was really exciting. But in his first year, not much P&L. But now is really in year two, really starting to do pretty well. And he did a video about 4 changes he's made that have helped him do much better. And for him, it was rigidity and routine, his size and risk management being more methodical, trading his psychological strengths, selectivity and capitalization through confirmation. But he's trading probably as well, pound for pound, experience for experience, as anyone at our firm. But it's taken some time.
Mike, can I jump in?
Yeah.
Yeah, so that trader that you're referring to, he had a style of trading that was working for him, and he had gotten away from it. And so being able to accept who he is, what he does well, what he sees well in markets, being able to accept that and build upon that, I think was an important element of his success. When he tried, and I've seen this in my own trading over the years. If I try to be someone different from who I am, if I get away from my strengths, I don't make money. And that's what was happening with this trader. And so acceptance of who he is and what he does well really helped him turn things around.
So there's a trader in this picture, I'm not going to point out which one, who in March made over $2.5 million and for the month. It wasn't the top trader at our firm, but monster month. And last year actually was the highest P&L trader at our firm. When we met him in college. He actually trained with us as a trader in college. He went through our training program when he was in college, and we ended up hiring him after that. He, in his first year, he traded through college. In his first year, he made about $60,000 US, his first full year of trading. In his second year, he made about $180,000. But it wasn't until the very last month of his second year that he made almost all of that. And so, his first month, he's kind of scuttling. His first year is kind of scuttling. His second year, he's really doing almost nothing until the very end of his second year. And he's gone on to be, one of the best traders at our firm. Last year, the number one performer at our firm. And remember, we have some really great traders. And, the thing about him is that he just has an extraordinary ability to select stocks. I mean, extraordinary. We don't have a trader as good as him at just understanding when there's just going to be a big order that comes into the marketplace. And he just gets in without taking any heat on the trade. He gets in with tremendous size. It's almost like he gets in and it's like everybody else can start buying now. And it's like, how did he know that thing was really going to go right now? I'll see it when it starts to get going, but he'll start getting in before it even gets going. I mean, he's just extraordinary with the stock selection. And, so you might say, oh, he has this immense talent to find stocks. And I think he probably does have some talent. But the truth is, when you break that down, he has a vast network of people he's talking to. He has a unique way that he develops his stock selection. He has insight into what some big retail traders are doing, what some sophisticated, bigger institutional traders might be thinking about. He's got this really cool network that he's developed, even though he's kind of quiet. But he's just reached out, made connections with people, he's chatting with people, he's emailing with people, and he's just put together this really neat network. And it's enabled him, after time, to build this incredible skill of stock selection and put it to use. As traders ask, do you still allow your traders to practice solely discretionary trading given the onset of automation? Yes, we do. So when you come into our firm, we train you to be a discretionary trader. You take S&B DNA, and then you take the winning trader. But then you're also taught how to use technology. So there are classes where you learn how to build alerts, where you learn how to build filters, where you learn how to build automated models. You're expected to be able to do all three of them. The last trader to earn a green shirt at our firm, you earn a green shirt if you make $1 million net in trading P&L for the year. That's sort of the big first milestone that you can get at our career, is to earn a green shirt. A green shirt hangs actually on our trading floor for something for people to aspire to. And so the last guy to firstly hit green shirt status is somebody who I'd call a hybrid trader. Somebody who trades with discretion, but also uses technology to express ideas, to find the best trades for him to trade. So on our desk, we have alerts that alert you to your favorite setups. We have scripts where you can automatically get into certain setups that hit the marketplace. We have automated models, rules in, rules out, to be able to trade particular market opportunities that you define. And so I've seen, and I think this is a really important question, because I've seen traders who were not going to make it as solely discretionary traders become seven-figure traders. They were not going to make it as solely discretionary traders. And there are certainly traders who, if you made them be quants or automated traders, wouldn't make it as well. But I've also seen traders who were just going to be okay as traders. They were going to be middle-class traders, but when armed with technology, have gone on to become seven-figure traders. And so one of the things we do encourage our traders at our desk is to have a weekly meeting with their teams to discuss the technology they can be building to find better trading opportunities, what alerts, what scripts, and what automated models they can be building together to increase their P&L. All right, traders ask, how have you adjusted your trading style? And Dr. Steinberger, if I can ask you to answer this, and strategies given all the events that have happened leading up to what the crisis has evolved to today.
Yes. What you've talked about with the S&B traders is the idea of playbooking, the idea of studying the ways in which the market sets up and the ways in which you best trade those setups. The challenge is that opportunities set up differently in different market environments. When we get a very volatile market where the VIX was around 60 as opposed to January when we had a VIX more like 12, markets move differently. They extend. For example, during the volatile period when we had the big decline, breakout trades worked really, really well. A stock or the index would trade in a range and break out from that range on good volume, and you could count on that breakout move extending. you could, as they say, nail and bail. You could get in on the breakout, it goes your way, quickly take some profits. If you try doing that in the low volatility environment, you wait for the breakout, it's already moved and it's ready to reverse. And so that same breakout trade doesn't work so well. You have to trade it differently. And so the really good traders not only study their best trades and playbook them, they study the new best ways of trading in the changed market environment so that they're always able to adapt. What that means in practice is that the traders are, even the experienced traders, they're always learning, they're always adapting, and in the team structure, they're learning with each other and they're learning from each other.
So remember how we talked about Shark hitting that career milestone of earning a black shirt? Well, that at the time seemed like a lot of P&L for him. In March, we'll slip that in a little bit, but in March, he made over $3.5 million in 1 month, and earning that black shirt for the entire year, and it really wasn't as big of an accomplishment as we thought at the time. But the reason for that, the reason for that is a couple of years before that, we had a recognition that we just weren't that good at marketplace. We were really good at trading individual names, but we just weren't good at trading the overall market. We weren't good at trading SPY. We weren't good at trading volatility products, and we needed to get better. We were leaving too much money on the table as a prop firm and needed to improve. We need to take ownership of that. And so I asked Dr. Steinberger if he would work with some of our guys on marketplace. His background is as a futures trader, and he came in and emphasized some indicators that the guys could look at that could be particularly helpful. And one of the ideas that came out of this boot camp on trading marketplace was you have to trade differently when the VIX is below 15 than when it's above 15. When the VIX is 12, stick with your stocks in play and the way you've been going about your business. The VIX is 15. Think about potentially trading SPY, Qs, volatility products. When the VIX is above 20, hey, now you should move to trading SPYs, Qs, the marketplace stocks, maybe the high beta stocks that follow along with the marketplace. Don't do what you're doing when the VIX was 12. That makes no sense. But because we had been working preceding this period of time in March on our marketplace stocks, and because we had built the playbooks to be able to trade the SPYs and the volatility products, when VIX was 60 and above, guys who 2 years ago weren't really that good at it really capitalized, and they had months, many multiples of their previous high months. It's that desire, it really is that desire to look in the mirror and just sort of say, I'm just not good enough at certain things. I really do need to get better. We're not good enough. And I remember saying this to Dr. Steinberger, we're just not good enough at marketplace right now. And this is going to be an issue for us going forward. We need to solve this. And this is we were doing fine at the time. And those traders were doing well at the time, but they wanted to get better. And they did.
And Mike, if I could just jump in, one issue that sometimes comes up with traders while we get a more volatile environment is that they see that there's more opportunity, and so they want to size up. But they're sizing up in a more volatile environment. So they end up taking way more risk than they realize, and that can blow them out. So you want to be careful about sizing of positions and risk taking when a market becomes increasingly volatile. It's very easy to lose more than you anticipated And that then affects us emotionally and affects our subsequent trading.
Traders ask, what advice can you give to proprietary traders who are making money but are still looking for higher, greater, and better profits? So this is Swang. This is Swang getting his black shirt for the first time. And he too in March made those numbers look quite small. But one of the things that Swang has done over the course of the last 2-3 years is learn to express his best trades with options as well. So he is a terrific equities trader, and he has grown the way he can express his trades with options as well. We noticed after one particular year that he had made some decent money trading options. Our floor manager challenged him to do more of that, to trade with a little bit bigger size, do more of it. It was working, keep doing it. And so what we encourage our traders to do is to express their ideas in different ways, to add different products. Interestingly enough, Swang had a pretty good month in March trading futures. He started trading for us the night sessions, for you guys the early session, but he started jumping in when the Asian markets started to open and trading US futures and having some success with that because volatility was so high. And Dr. Steinberger wrote an interesting tweet a while back, which I think speaks to this. And we spoke to this a little bit before. And so, the question is, well, how do you get better? How do you make more money? And the answer tends to be, and I don't want to put words in your mouth, although you did tweet this, so I don't know if I'm doing that. It's on the public record. The answer tends to be what Dr. Steinberger is saying here. What trading do you do that is truly gifted? Or do your true gifts lie outside of financial markets? So much of success is figuring out what you're meant to be doing. And so Dr. Steinberger is too humble to bring this up, but Swang is a model of consistency. Throughout the years, his P&L has been very high and also had very little drawdown, very few losing days, very few losing weeks. But prior to his historic March, he got off track. He started to see drawdown. And he started to see drawdown because he started to get away from what he is truly gifted at. He started to do more swing trading that got in the way of what Dr. Steinberger says is his swang trading. Don't let your swing trading get in the way of your swang trading. And we looked at his trading results from TraderView, and Dr. Steinberger saw what he was doing and said, hey, get back to what you're doing well, get back to more of that active, quick thinking, short-term trading that has built your career and what you're special at, and move away from more of the PM work that I'm seeing you do. I wrote this weekend, some of the best active traders are reaching new levels by taking less risk, reducing stress, lowering drawdown, better consistency, collaborating, and not holding through pain, fighting price action, increasing their holding time, nor predicting. Now, look, I want to say that there's lots of different ways to trade. I am talking about active traders, and these are the active traders that I'm coaching and mentoring and are working at our firm. So I'm not suggesting that this encompasses all traders, but there's a commonality as to how the best active traders are reaching new levels. There's a through path through their best trading. It's not what you hear people talk about on cable TV. It's not. What you hear out there on cable TV or the mythology out there about what great trading is all about is, I've got to have a really strong stomach. I've got to really be able to take a lot of pain. That's how you become a really good trader. I got to man up. I'm not seeing that with the best traders. There's this thought process that they got to be the ones that predict the market's going to go down today and really catch that right. I'm not seeing that with the best active traders. And this is mythologized in, movies like The Big Short, where, we marvel at the people that can just call the turn. I'm not seeing that with the best traders. I'm seeing the exact opposite with these proprietary traders reaching new levels. And they're purposely structuring their days and their trading to take on less risk, to take on less stress, to draw down less, to be more consistent. And they're making more.
And Mike, if I could jump in, psychologically, what those best traders are doing is they're quick to accept when an idea is not working out or when a trade is not working out. They don't view it as a defeat. They don't view it as a failure. They are quick to accept it's not working out and move on and learn from it. And that allows them to be flexible. It allows them to go after the next opportunity. Great traders are great at taking losses. They're also quick at taking losses.
Traders ask, how do you know when it's time to give up as a trader or on a trader? So I received this email from a trader who was 10 months into his trading career. And in short, he was struggling. He was at the bottom of his trading class. And he asked me the question, at what point should a trader give up? He was at a tier 1 prop firm, had a great mentor, really bright person, loved trading, called him up, had a talk with him. And he really still loved trading. He had a great mentor. Mentor was one of the great day traders of all time. He had a firm where they had tremendous resources. He had a firm where they were still backing him and believed in him. And he had the cognitive skills to succeed as a trader based on my experience. And so I said, hey, let's give this a little bit more time. Why don't we re-up? Let's give this a year and a half. Let's re-up and see how you're at. This trader was really thinking about moving on. You can see from his email, he was in pain as to him not succeeding at this point. He was in pain. It was crushing him. First time in his life he had really experienced such a consistent period of underperformance at something that was important to him. And he kept at it. And I think what I'll tell you about this trader might surprise some of you. Look at that email. That's how he felt 10 months into his trading career. Should I give up? That trader today is really one of the best active proprietary traders in the US today, hands down. North of $5 million in profits, is going to make 8 figures one day. It's just a matter of time. One of the truly great success stories. 10 months into his career, seriously considered giving up. And so, for a firm, we think about, is the trader improving? We think about, does the trader do the work that shows he's passionate about trading? We think about, does the trader have some ability? We think about, is the trader progressing? Are we seeing that in the numbers? We think about, how is the trader doing relative to other people in this class? Because there are markets that are better than others. And if you're falling behind in a market like this, that does say something. I think the biggest gift that my firm gives to traders that very few people talk about is time. We give you time. Pay your bills. You don't have to worry about the rent. You don't have to worry about, eating and hitting the gym. We take care of that. It's time. We give you time to grow. You need time to grow, even at a firm like ours, where you have all the resources that you need in the world to succeed. All the capital, all the coaching, get to work with the best trading coach in the world like Dr. Steinberger, all the other great traders around you who are succeeding, whose strategies you can see, all the mentoring and coaching meetings we give every day, the AM meetings from Spencer, the training people go through, the technology that people get their hands on. It's time. So, but if you're not improving and it's something you don't enjoy, you do have a real decision. And I would say that the niche you trade is important. I got this note from a former S&B intern recently, which I think teaches a really important lesson. And he wrote, "Hope your family's doing well. Some backstory on myself since we last spoke. After my summer with S&B, I realized I didn't fit in with day trading. Personality-wise, trading stake size at the time, etc. Absolutely loved that summer in New York and continue to cherish it. Being in an environment where people constantly wanted to get better and getting to interact with people awesome at their sport. Getting to go to your Saturday morning breakfast invitations, spending the weekends in Central Park, writing in my journal on what happened that week. I feel like it puts the spark back in my eyes when I think back to it. It was a tough blow at the end of the summer, though, when I realized I was not a total fit for trading at the time. After graduation, I spent some time with Firm Redacted in the prime brokerage group in Florida, and eventually moved to Firm Redacted to work on the research publishing side at Firm Redacted. Not a total equity analyst monkey that you see on CNBC, but sometimes feels close to it. I'm now in London doing the same thing. I've done a ton of traveling prior to the shutdown, and I'm moving up the ranks, making decent money. But I miss that environment of where people want to be peak performers. In my job, I imagine most of corporate jobs, you get paid to grind it out and not screw up too much. There's not much upside in being a peak performer unless you're some kind of rainmaker. That doesn't stop me from finding other areas of investing and trading. I've focused on building my playbook now for these opportunities, and I find the longer term trading focus while having a full-time job gives me psychological comfort. I have a job with monthly income, so I don't have to trade if the setup isn't there. I wanted to pass along this message, one, to reconnect and say thank you again for that learning experience that summer and the great content that your team continues to produce. Two, maybe my message can provide some hope and belief for the young traders that reach out but maybe aren't cut out for day trading or find that it doesn't fit who they are. I feel like we each have our own path to take and learn from. And so it just may be that the niche that you start in is not the right niche. And it's okay to say that. It's okay to say that to yourself. It may not be that trading is the right thing for you, but you can see there are plenty of people who I've worked with who have taken their experience as traders and parlayed that into really incredible other experiences in finance. Trading is the top of the food chain. It's the hardest thing to do in all of finance. It's the hardest thing to do in all of finance. It's the very top of the food chain. There isn't anybody above traders. And they say in baseball, the hardest thing to do is hit a baseball. The hardest thing to do in finance is to be a discretionary trader or to be a P&L trader of any kind. It's the hardest thing I've ever had to do in my life. And so it's okay sometimes to say, hey, maybe not this type of trading, or maybe I'm going to do a different type of work in finance. Our traders ask, how do you know how much you should allocate funds to a certain trader versus another trader? Current setup in our firm here is that we range allocation from 50,000 to $1 million, depending on the trader, but the criteria for deciding who gets more funds is often questioned. So I'm going to let you guys handle that amongst yourselves. I'm not going to pretend how I should answer that question, but I can tell you we did have an issue like this at our firm. And so we have a team that wanted more capital for a particular strategy, and the strategy was being traded by other traders at the firm. And we were starting to run out of capital for this particular strategy. Not only were we starting to run out of capital, but we didn't really even want to put more capital into one particular strategy, as that creates too much risk for the firm, for everybody to be piled into the same idea. And so, but it was a strategy where it was really working. Everybody at the firm saw it, and everybody wanted to do it. And we had this question of, how do we decide who gets what? This one team came forward and said, "Hey, I want a lot more. I want a lot more capital." And they said, "Here's why. Here's why we deserve it." They had developed a unique data set that gave signals that allowed them to perform better than anybody else at the firm in the strategy. They had collaborated to improve the strategy so that its profitability was better per dollar than anybody else's at the firm. And they were actively doing the work to show that they were doing better, and they had the stats to back it up. And so we had to think about it, and we said, yeah, I mean, they deserve to have capacity capital for that particular strategy, and we went and decreased some of the capital for some of the other guys. But I think overall, one of the things that we do on our firm is we tag and measure all of our trades. We keep statistics on all of our setups. They have names, they have stats behind them, and if traders show that certain strategies are doing well, then they've earned the right to be given more capital. But remember, they've earned that right. They've shown it in real time. They haven't just come in and said, I really think this would be a great strategy. I really think I would be great at running it. I really think I deserve more capital. I really think if you gave me more capital, I would do well. They earn it. They show it.
Mike, can I jump in?
Yes.
Okay, so at hedge funds where I've worked, I've been part of the capital allocation process. The way it works is, first you have to show positive results. Then you have to show that you have positive risk-adjusted results, which means that you make a good amount of money relative to the amount you lose. That can be captured by a Sharpe ratio or other statistics. So it's not just how many total dollars you make, it's how much do you make per unit of risk that you take. They want to see good risk-adjusted returns. Then, once you show good returns and good risk-adjusted returns, they want to see unique returns. Are you doing something differently from other traders? If you have a big trader who is successful and then a junior trader who wants more capital, but who is very, very highly correlated with the big trader, why should you give the money to the junior trader? Just give the big trader more money. So it's not enough to show good results and good risk-adjusted results. You have to diversify the trading firm. This is a capital allocation portfolio construction problem. The firm has a portfolio. The portfolio consists of the returns of the different traders. Any portfolio needs to be diversified in order to give consistent returns. So you need traders doing different things, not simply copying each other.
Hi, Brett. Can I jump in?
Ew.
Yeah. What other ratios do you guys look at primarily when you're evaluating traders?
It varies firm by firm, but it's not so much ratios. What they look at are factor exposures. So, for instance, they will look at different periods of time. Is the trader correlated with overall markets? Is the trader making money more on the upside than the downside? Is the trader making money in a momentum fashion? They're looking at different factors to see how this trader makes their money. And they're looking for diversification of those factor exposures. That's really one of the most important things that they look at. So are they making money uniquely? They look at correlations, but they'll also look at how the money was made. Are they doing value investing? Are they making their money short term, longer term in different markets, et cetera, et cetera, et cetera?
All right, thank you.
Oh, absolutely, absolutely. I did a webinar recently, and someone talked about how their style of trading, that they were making money by sticking to their style, and their style was to be short the market. That's not a style. That's called a bias. That's not called good trading. That's called being an idiot. Seriously. And I said to him, it'd be like a baseball player who said, well, I only hit fastballs. That's my style. Well, guess what? That baseball hitter is going to get a lot of curveballs and off-speed stuff. So we want to stick to a style, do what best, but that style has to be adapted to various market conditions, ones that are trending, not trending, volatile, less volatile, and so forth.
Eleanor, we'll take one more, and I'm going to ask Dr. Steinberg to answer this. We're running up against our market preparation in New York.
Yes, I got to get going.
What are the best techniques to handle drawdowns and losing money, Dr. Steinberger?
The best techniques to handle drawdowns and losing money is to draw down and lose money the right way. In other words, we have daily loss limits. The S&B traders have that. We have loss limits per trade. Those would be stop out levels. And so we're losing money in a planned fashion. Now that sounds a little bit funny that we actually plan to lose money, but you have to. You have to anticipate that this is a probabilistic game. Sometimes the probabilities don't work out. Sometimes ideas will be wrong and trades will go wrong, and you want to lose the right amount of money. And so anticipating losses and making sure that you can always come back from those losses is the right way to draw down.
Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.